All right, welcome everyone to Value Investing Live. I'm pleased to welcome our guests this week, Joel Hirsh and Bryan Engler. Joel leads Kovitz's equity research process and develops portfolio construction for the firm's core and hedged equity strategies. Bryan is a member of the investment team with a focus on deep fundamental research, complemented by a rigorous bottoms-up valuation process. Both are CFA Charterholders and are members of the CFA Society of Chicago. For those of you out in the audience, we do encourage you to please post those questions and comments in the chat throughout the presentation, but do keep in mind we are going to hold those until we get to the Q&A at the end of things. Without anything further from me, I'll go ahead and hand things over to these two gentlemen so we can jump into the presentation.
Great, thanks very much. So we're going to do our best to just walk through sort of an overview of what we do, and then we look forward to your questions. We certainly hope that you have some. We spend most of our time doing research, not presenting, as you'll probably be able to tell. But we'll do our best to give you an overview and answer any questions you have. The first thing we're going to talk about is the firm. We are very fortunate to work at a firm with about $6 billion in assets, and it's an interesting firm because it is run by investors with a focus on performance. And essentially, we have developed an offering where we have engendered a very long-term capital base. We have both holistic wealth management and financial planning coupled with deep fundamental proprietary investment strategies, and they go together. And our offering basically is at one fee that we think is very competitive, if not lower than most of the firms we compete with. We will do everything you would typically get from a high-end private bank or other wealth management firm. But the difference is we are bundling two services. We have all the expertise on the wealth management financial planning side, but we also have fully built out institutional equity research, fixed income research, and alternatives. And we think the combination of the two is a significant differentiator for compounding our wealth and our clients' wealth over time. We think you can see that, and that we've got, for the investment team, over 90% of our liquid net worth in our own strategies. And we think that's very important because all we're trying to do is actually invest with a long time horizon as if it's our own capital. And obviously, when you got your own capital invested, it is your own capital. The other thing that we think is really important is that because we offer this level of service, you think about $6 billion in assets, our typical account size is 5 to 10 million. And so we have basically developed capital base that is very close to semi-permanent. And that has allowed us to stretch our time horizon, which we think in this industry, to have a 5-year horizon is very rare and a significant differentiator. So that's generally the firm overview. Bryan, anything you'd add to that?
Nope.
Okay. So this is a snapshot of the team. As you can tell by the pictures, we read a lot for a living. And a couple of things I would note here is that we've been together a long time. Bryan's the newest member, been here for 2 years, but we spent a significant amount of time, the 2 years prior to that, getting to know each other, making sure it was a good fit. And I can say that it's been tremendous, seamless coming together. I really think that you watch all these videos, you do diligence different firms, everybody says similar things about their team and how we spend our time. I do think having operational control, being an independent firm where the investment team is in charge, is a significant thing to keep in mind because we are focused on investing. We have separate locations for our research office and our wealth management office. Our job really is to read as much as we can and to debate and to try to facilitate a process where everyone can disagree all the time. And that's what we're shooting for, working together, but also independently. And I think we've been successful at developing that. The other thing I would say is the team is purposely small, and we really like that. We think if you look at the best track records over time, it tends to be a small team where the PMs are doing their own research. And that's something that we're always going to believe we need to maintain.
Great. Thanks, Joel. I'll run through some of the principles for long equity. There's a lot to cover on these slides. I just want to touch on some of the highlights. I was going to apologize in advance. I'll probably reference a bunch of quotes kind of a bona fide collector of quotations. There are 4 key tenets to our philosophy: a private owner mentality, focusing on capital preservation, having a long-term view, and being concentrated. We think a private owner mentality is the only real way to align our incentives with our clients. Overriding intention for managing the fund is to treat it as if it is all our money, because all our money is invested in it. It also means that we look at stocks the same way we look at perpetual private equity ownership. We think less about the vagaries of how a stock will be priced in the short term or what other investors are thinking, and we think more like a private owner. We're concentrating on setting up our affairs so that we're balanced between surviving and thriving for the long term. It goes without saying that the twin concept of this mindset is that preservation of savings is key. We'll not take any undue risk that can take us out of the game. At the same time, we know that growing our purchasing power is the key to maintaining our real wealth. These 2 tenets of a private owner's mentality and capital preservation are operationalized to the next 2 pillars of our philosophy: having a long-term view and being concentrated. In real terms, to grow one's savings means to focus on compounding, which in our mind is best done through higher return businesses that can survive and invest for the long term. The first among quotes below epitomizes this concept. High return on capital and high moat businesses can turn time into your friend. More often than not, this will help one manage through the myriad of unpredictable eventualities that one is sure to encounter in their investing lifetime. As Joel mentioned, our partnership with our high net worth capital base and like-minded institutional investors is a key advantage for us versus an industry that is focused on asset gathering. We're not focused on beating any particular benchmark at any particular times. We sometimes think that mindset compels an investor to think on a shorter term timescale. Instead, we just focused on compounding. The next item of concentration. Diversification sounds great in textbooks, but in reality, the opportunities that really matter are very rare. We have set the core books up so that there's only roughly 30 to 40 names, so our best ideas can truly shine through. Every time we do something, we're asking ourselves, can we park money in here for a long time without losing any sleep over it? So if this is the philosophical underpinnings, what are we hunting for? There are 5 main things we're looking for: great business, a long runway to reinvest, strong balance sheets, excellent management teams, and ideally a great price. Frankly, there's nothing on here that is novel. Munger, Buffett, Fisher, et al. Laid this all out in pretty clear language over time. It just takes a lot of groundwork to find these opportunities and, more importantly, be ready when they present themselves.
Yeah, and I'll just add.
Go ahead.
I'll just add to that. We feel strongly we're not smarter than all the people we're competing with. There are a lot of very smart people in this industry. I think one of the insights we've had, if you even want to call it an insight, I'd give Mitch a lot of credit for this, is we've invested a lot of capital in setting up the business and the framework in a way that we think advantages us. And we think we need those advantages over time because of how intense the competition is. But with how the world is evolving, most of the competition keeps shortening their time horizon. And if we're able to expand it, as Brian's talking about, we don't have to be absolutely the smartest. And we think that's very important. And so everything we do is always setting it up to be able to find these things that everybody's looking for, but maybe being able to differentiate by saying, yes, we recognize the problem for the next 12 months, but if we were willing to own it for 3 years, under a multitude of scenarios, the IRRs are attractive.
Yeah, that's a great point. The other thing it allows us to do is be a little bit more adaptable in our thinking. Today's environment requires a little bit of extra insight that one might have to dig deeper into the unit economics of a business to see how great an operation really is. This has hung up a number of our value investing brethren who've been really focused on bottom line numbers or ratios, but we don't see this aspect of diving deeper into the business as being any different than looking at a name like Walmart, who ran negative free cash flow for years as they grew out their store base. It's the same idea now with a lot of new line businesses. The accounting just looks different. And I also just add, we know that not every environment serves up these 5 opportunities in equal proportion. We know that not all of our investments necessarily have all 5 of these attributes in equal proportion, but we think the paradigm is one that's important to keep in mind. Anything else to add, Joel?
No, totally agree.
So the nuts and bolts of the research and investment process, everything starts with a hunt for the qualities we listed on the previous slide, except for the issue of price. If we find some combination of what we're looking for, it enters the universe. There's a duality here. The duality of casting a wide net and also focusing on what you know. Peter Lynch said, the person who turns over the most rocks wins the game. And there's something very true about that. You need to make sure you know your opportunity set, and you also need to work very hard to make sure your core competency is expanding. On the other hand, if you can't have confidence in what a business is worth under a wide range of scenarios, it's really hard to allocate capital effectively. The opposite of that Lynch quote to me is Keynes. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums into enterprises which one thinks one knows something about, and in the management team of which one thoroughly believes. We're constantly pushing the boundaries of our circle of competence and also realizing that businesses we thought we knew and believed in really don't fit our criteria any longer. This creates turnover in our universe, which historically has averaged 10 to 15% annually. I always think old line retail is a great example. Almost across the entire investment team, we had deep domain expertise in this area. And over time, we saw many of our once favorite businesses fall out as we just lost confidence in our ability to see the future in that business. The upside to that is that got Amazon into the universe a few years ago. And our research process was able to continue to grind away at understanding that business as we expanded that circle. I'd actually argue that this first part of the chart is where the research team spends the majority of its time. From here, referencing the universe, typically a champion of a name will emerge and push forward an idea for review. Everyone on the team is a generalist, and while there are distinct areas of expertise in the group, we strive hard to ensure that non-consensus thinking is highly encouraged and rewarded. Any team member's voice can carry the day, even if they're a novice in the space. In fact, we've often found that people who are not as well versed in the name sometimes can see clearly into the issues at hand. It's also in this middle stage that we only really get serious about considering price. At some point, the voting members who've been involved in the process from soup to nuts will eventually call for a vote once there's a sense the team has wrestled with the pertinent issues. It's important to keep in mind, we do not vote by consensus. A single strong yes vote can get a name into the portfolio, despite other members still being more neutral on the name. Conversely, any voting member can veto an idea at any time for any reason. They can simply raise their hand and say, I'm not comfortable with this, and the idea ends. The result of how this voting process proceeds has a large impact of our view on our confidence in idea and its position sizing. Which then gets to portfolio management. There's nothing fancy here. There's no sophisticated VAR modeling or mathematical formulas. We're simply thinking about the portfolio as our own personal conglomerate. We're often focused on what can we realistically predict. The world is going to need more computing power over time, not less. Consumers are always motivated by some combination of quality and price. Those things never really change. Often, our largest positions are not based on how much we can make, but how confident we are that we won't permanently impair capital under a wide range of scenarios. It's easier said than done, but it goes back to the fact that the vast majority of the team's capital is invested in the product. Also, unlike academics, we don't view volatility as risk, but rather opportunity. We're happy to add during periods of distress for businesses we really like. We're also equally happy to buy more of a business that's working, that's fundamentally performing, but yet Mr. Market is not rewarding it the way we think it should be. Anything else?
And I'll add a couple things that you touched on, not academics, and I don't want to say anything too disparaging towards academia. There's a lot of value. We all start from the same place, reading the same textbooks. I do think some of the footnotes aren't taken as seriously over time as people venture out into the world. Once you own 30 stocks, if you're truly paying attention to shared risk factors, you've already diversified away most of the market vol that you can. And one of the things that we think is interesting is we track our performance in drawdowns of greater than 10%. And it looks very, very close to a portfolio of 500 to 1,000. And there's almost no difference when you get to 19,000, frankly. And yet, if you were to just say you wanted more diversification through your equity book, you didn't pick up enough for the give up of 2 or 3% a year in actual return. And so this concept of really knowing the businesses, we spend a lot of time debating and arguing where's our shared risk factor exposure. And I think you can see in times of stress, historically, when we look at our results, we've done a good job of understanding that. And part of the reason has been, these are real businesses to us. And the real businesses where we think a lot about, if things go wrong, it's worth X. If things go right, it's worth Y. And I actually think that's easier to execute than things like risk factors and things that feel more academic in nature, but because we're imperfect human beings, are actually harder to put into practice.
Great. The next two slides are just some of the obligatory snapshots. This is just our top 10 and some of what it looks like at 12/31. It's pretty typical for us to have 40 to 55% of our capital in our top 10 names. I will note that looking at the top 10 is usually a good way to see how we judge the opportunity set. As the opportunity set is better, we'll actually be more concentrated over time, not less. Next is the obligatory performance slide. This is really here just to show that the process works over time, but not every time. And we're very comfortable with that. I actually think the next slide, rolling returns, is a little bit more indicative. I really don't know anyone who sets their capital allocation plans on New Year's Eve. So I don't really understand why 12/31 is the date which everyone measures. I actually think that the more important timescales are longer. Internally, we think in about 3 to 7 year horizons, even though we've owned a number of businesses for quite a lot longer than that. The important thing to pick up here is that as you stretch out your time horizon, our process really shows that it works. 2020 was actually pretty interesting in that matter because it was a year where our process really shined. It was, as far as I know, our most active in fund history, which is strange because we typically do not have very high levels of turnover. COVID created a unique opportunity to really upgrade the quality of the book at great prices. We bought 11 businesses between February and April and 13 businesses for the year. I will say, we bought some of those as we were hiding under our desk and probably scared like everybody else. And we were pretty surprised by the speed of the bounce, which limited our ability to put more capital to work. This is a snapshot of the portfolio companies that we bought for 2020. You'll notice there's no thematic investing. There's nothing that really links them, except that they're all good businesses with enviable returns on capital, especially versus their peers. They all have very attractive reinvestment opportunities. They're run by excellent managers, and they're all bought at prices that had, in our mind, a huge margin of safety. You'll see some of the companies are what others might call classical value, or old line industries. Lowe's, Hasbro, Lockheed Martin, Becton Dickinson, Northern Trust. Some are very classical compounders that have been well documented. NVR, Charter, Visa. Some are businesses that are in the midst of a transition that the market really hasn't caught on to yet, like Keysight or Motorola Solutions. And then there's others that our peers call growth companies or new line industries, like Arista, Autodesk, and Amazon. The key point is, internally, we don't think about those heuristics at all. It just comes back to really what we were looking for in the first place, which, again, good business, good returns on capital, great managers, and a great price. We'd be happy to walk through any of these during the Q&A. Joel, want to talk about hedged equity?
Sure. So in addition to our core equity, we also have a hedged equity strategy, and the same research process feeds it. And effectively what we're doing is we're taking our core equity portfolio and wrapping a hedging program around it. Mitch had an insight 20 some years ago that before you buy a stock, shouldn't you at least check the options market? Because when you buy a stock, you have a linear payoff profile. And we are doing our best to skew the odds in our favor. So if you were to, want the pain of suffering through this YouTube again, and you went back to the rolling returns data, which you'll notice in those 7 and 10-year periods, 5-year periods, I'm not as proud of the percentage of times we outperform. I'm proud of the skew. That when we outperform, it's by a much greater magnitude than when we underperform. And I think that that's the data point that shows our research process is working. Because when we initiate a position, like we did in this last March, we don't know which future scenario is coming. We're trying to benchmark what we think the payoff profile looks like. If we're wrong, we'll lose 20%. If we're right, we'll make 100%. Was sort of what we were looking for at that time. We were looking for doubles. In hedged equity, we basically take the entire portfolio and we convert it to a payoff profile. And what I mean by that is that the fund can earn a return either through stock selection on a relative basis, significant moves in either direction up or down by broad equities as an asset class, or by increases in volatility. So you've got 3 different ways to generate a return. And when you couple those together, if you were to plot the expected return of the fund for 1-for-1 moves in general equities, what you would see is a payoff profile that is much more attractive than I can build with stocks and bonds alone, right? So if I wanted to have so much hedging that in a 20% drop, I felt very well protected, I'd have to have 90+% of my assets in bonds. But if I had 90+% of my assets in bonds, how is it I could possibly generate a high enough return to where I'd want that for my portfolio? And so in the current setup where interest rates are very low and equity valuations are medium to high, depending on how you want to look at it, this is by far the most attractive payoff profile we can find, because there are scenarios where our equity book does double-digit returns, but there's also scenarios where, hey, something went wrong and interest rates are 5% on the 10-year and there were no good stocks to buy for the next 5-year period. And by the way, your mark to market on bonds went poorly too, but this thing's not going to move like either of them. And I think for an individual investor, or frankly, a number of institutions we've spoken with, when they're putting together their asset allocations and they're running simulations on the future, but they're assuming historical rates of return, it's always suspect, but particularly so now, because you've got very low interest rates and historically high valuations. And to assume you're going to get historically average returns for both stocks and bonds from that point seems like a very low probability bet. There's a limit to what I can talk to about this strategy in this venue. We do have a mutual fund. There's more information available on our website. But those were pretty much my thoughts. Bryan, anything you think I should add?
No, I think you covered basically all of it. I think we can take Q&A if people are interested.
Yeah, so one of the interesting things, one of the interesting questions I've received over time, and one of the things we've looked at is, when you put together a portfolio and you're thinking about risk, are you trying to smooth the little moves week to week? Or are you trying to have something that can smooth the portfolio for large moves? So I would argue that if I'm putting together a portfolio on the equity side, and my goal is to smooth the volatility, you can succeed in smoothing it in a statistically meaningful amount by having 1,000 stock holdings, right? For most weeks, there will be lower vol. Whether or not, practically speaking, you'll sleep better or your decisions will be better because of the lower vol in low vol periods is a debate. The thing about correlations that I think the industry purposely makes confusing is that they're not static. They change both over time and they change intra-period. So over time, correlations change because the world changes, right? 30 years ago, correlation between European equities and domestic equities was lower. And it was lower because if I wanted to buy stock in Adidas, major company, obviously, that you could buy right now on your iPhone, no problem, I had to open an account with the German bank. I had to speak a different language because I had to call them, or I had to find an intermediary to help me. I had to deal with the currency effects, and I had to then go buy a stock on a different exchange in the middle of the night, right? There was actual friction. So it would make sense that correlations would be not one. Today, I'll just take out my phone, I'll open up the app, and I'll buy it. And so is it really surprising that when you track correlation between developed international and domestic large cap, they've tended to go up over time? So that's number one, is that the correlations don't stay the same, yet the historical diversification models assume they do. I think that's very questionable. Number two is that correlations aren't all equally valuable. So if you're tracking correlations for drawdowns of 1%, if you've got a correlation of 0.8, and so your portfolio falls 1%, or the market goes down 1% and your portfolio has a correlation of 0.8, what are you going to do with the extra 20 cents? Like, it's just not a meaningful thing. There is nothing to do. If you were to track conditional correlation, so only when the S&P falls 10%, how much did your equity book draw down? You would find that over 10% drawdowns, whether you've got 30 stocks or 100 stocks or 500 stocks, you're down 9, 10, 11, right? It's not enough to where you've got enough dry powder to say, you know what, stocks are down 20%, I'm down 19. That's not enough to rebalance. That's not enough to take something out of some other asset class and buy these cheap stocks. And so all I was saying is, wouldn't you rather just have better returns in your equity book and know that if stocks fall 20, you don't care if you're down 18 to plus 22, but handle the diversification in some other asset class, whether it's hedged equity, fixed income, real estate, et cetera, so that during periods like March, you've actually got a pot of money to pull from to go buy more equities. And in exchange for that, you can earn a higher return, and you'll just live with slightly higher volatility in the, what I would consider not meaningful week-to-week periods.
Definitely. And for those out in the audience, my apologies. That was an answer to the first question we did receive on explaining the concept of drawdowns. From here, looks like we do have another question coming in. When looking at different potential investment opportunities, how do you measure inherent risk, and do you think that there's actually a way to truly calculate it? Is there really a way to put a figure to it?
I think we would say there's actually no mathematical way to get comfortable with what risk really is. I think the only way to really think about it is how likely is this business not going to exist in 5 years or some other time horizon that you're comfortable with. And that usually comes down to things that are very difficult to quantify. It's, what are the competitors doing? How's management allocating capital? How honest are they being? What's the regulatory environment? None of these things fit really well into a spreadsheet. I think managing risk over very short-term timeframes, yes, you can put a mathematical model around that, but not if you're really going to stretch out 5, 10, 15 years. It's almost impossible.
For sure. And I guess expanding a little bit more on that question, are there any particular sectors that you guys believe are, I guess, more inherently risky, or ones that you would choose to stay away from for the most part on a day-to-day basis?
So I think that, go ahead.
I was just going to say, it's not that things are inherently risky. It's that we really know we don't understand certain types of businesses. And that makes it risky to us. And I've seen a lot of really smart people who invest in other sectors, and it's not risky to them because they know it and they feel very comfortable with it. They know the players. When bad things happen, they are able to see past the valley, where there's areas where I certainly can't.
Yeah, I just think this whole concept of risk is an interesting thing because ahead of time, you don't know the risk. And then the volatility you observe afterwards was not necessarily representative of the risk you took, right? Like, What if the large content studios had never sold their content to Netflix beyond the first time? Netflix would have been deemed outrageously risky instead of an unbelievably moated business. At the time that investment was made, you're dealing in probabilities of the future, and there's downside scenarios and there's upside scenarios. And so everything for us is company by company, and we try to understand we can't be precise, and we're trying to say, if we're wrong, we think we're going to lose this amount. And we've been pretty good at that over time as we track it and we do our postmortems. And I think that's a big part of what has generated our skew over time. But you don't know. It doesn't fit the spreadsheet perfectly. So you spend a lot of time on all the qualitative things Bryan's talking about, and then you try to quantitatively say, I bought the whole business, right? I took my entire life savings, I bought it. We have something called the 5-year rule. If you had to go to sleep at night for 5 years, the market were completely closed, could you sleep at night? And we use idioms like that to help us think, do we really understand the risk of waiting? What will be the earnings power in 5 years? What will be the value of that earnings power in 5 years? And there is no way to capture that. After the fact, you can capture it. But if you're buying good businesses that are moated, that you understand, you end up asking yourselves, how wrong can we be on the earnings power? When you start getting into things that are really complicated, that require a lot of brain power and a lot of thought, and the research looks really impressive, and you'd be excited to share it to show how impressive it is, my history with those is losing almost every time, because it's very difficult. It's a very difficult bet to make versus something like Becton Dickinson. There's a lot of chance we could be wrong on our base case and our upside cases for what we think it's worth, but to lose money on it, you need a disaster, in our opinion, over 5 years from the price that we paid. Because essentially what we're saying is the pandemic is temporary in terms of depressing elective surgeries, whatever's deemed elective, and that their company-specific issues around a couple products will pass over time. But at the end of the day, their distribution and their R&D are moated advantages. And under a multitude of interest rate scenarios, the operating profits they generate are just simply worth more than it was trading at the time we bought it. And even if we assume all sorts of bad things happen, it's going to be very difficult to wake up and say you significantly impaired your net worth owning that company. And that's how we try to do it. And because we know we're imperfect at it, there's generally 30 plus stocks in the portfolio, and the weightings have a lot to do with our assessment of skew over time.
Definitely. And a nice, I guess, connection there to make, looking into our next question here. On the note of actually looking at those upside and downside potentials, are there any specific metrics that you guys really like or lean on for the most part?
I can talk about that for a minute. I actually think one of the things that we're most proud of internally that is, it's sort of difficult to articulate well, is purposely know that if you were buying a business, actually buying it, you're going to take your entire life savings and buy it. There is not one multiple or one ratio that you would use. And you would use whatever set of tools you have at your disposal to come up with a range of scenarios of what it's worth out in the future, both up and down. And we think that thinking in terms of probabilities and IRRs is the best way to do it. So we may use a different set of tools for Autodesk and Becton Dickinson, but then because we're always self-referencing, we'll speak in terms of what do we think the expected IRR is for each. And I think that's one of the things Bryan can talk to greater is we've seen a lot of people hung up on Autodesk must be really expensive because the PE is high. And we couldn't disagree more strongly.
Yeah, I think that's also the advantage of the team base. We often find that when one of us is analyzing a name, someone out of left field comes and just shows us why that's just the completely wrong way to look at it. And like there's nothing required of us for anything. If you were to pull up any of our models, like they don't look the same. Like we're not thinking about this one thing being what drives the business or not. We're thinking about if we own the business, what would be the 3 or 4 things that drive value for us? If a competitor really impaired one of those things, what would happen to us? That's really how we're thinking about it. Now, it does get translated all into a common language. And that's a different process, but it's not a PE ratio for this and a revenue multiple for that is the right way to do it. It's really thinking like a private owner.
Definitely. And on that note, next question actually on our list is asking how important, and I think we've sort of hit on this already, but how important would you say forward PE would be in your analysis, if it even really has a role to play?
Sometimes yes, a lot. Sometimes not at all. I mean, usually the next year's earnings is not really what the entire worth of the business is. But there is some power in looking at that. I don't want to deny it.
I just think that's an area of intense competition. And what we're saying is that if you own the whole business, then you would think about, I bought it today, I'm going to compound my operating profits for the next 5 years, and then I'm going to sell it. That is an increasingly less crowded area to play in, and it can allow arbitrage opportunities, in our opinion. So it's not a meaningless thing, next year's PE. It's something that we look at. It can be an early indicator when we're doing the work. But there are times where the high next year PEs are better than the low next year PEs, or the middle of the group is better, or the low ones are really terrifying, in our opinion. It just varies business by business. Bryan likes to talk about being business analysts versus stock analysts, and there's a role for both, oftentimes in the same portfolio. But being a business analyst has major advantages and is less crowded. And that's what we're trying to do. Literally, what is the business worth?
Absolutely. And continuing on now to our next question, do you have any thoughts on an ETF as a medium to shelter investors from the impact of trades?
We have thoughts. Execution is difficult. I don't think we have anything else really to say about it, other than we are thinking about it. And I think a lot of people in the industry are thinking about it too.
Definitely. And continuing down, do you hedge against currency fluctuations, and how important are those currency risks in your analysis?
Generally don't hedge against them, and they're generally not very important. The market is good at over time. The historical example was Coke versus Diageo, where they're basically mirror images of where they're domiciled and where their cash flows come from. The currency risk will matter over a short period of time, but the value will adjust for it over a longer period of time, just by the way it works through the income statement. Bryan, do you have anything you'd add on that?
No. The issues with currency is we just know we can't predict it. It's something we just don't. Once you know you can't predict it or you can't really forecast it, we kind of stop thinking about it. We're aware of it, but forward thinking about it, not really.
Definitely. And the next question we have coming up here, would you say that risk varies based upon the price you pay?
Absolutely. Bryan, you want to talk about this? You want me to?
No, and Joel's right, absolutely. The price you pay is the number one determinant of how much risk you really took. I think that gets confused sometimes with the price you pay indicates whether you made a good investment or a bad investment, or really that it's a good business or a bad business to buy. Those two concepts are really different, and they should be. But the price you pay really affects how much risk you're taking. And one of the easier things about being a long investor is the business you like keeps getting cheaper. Your risk keeps going down, not up. We like that skew over time. That makes us feel really comfortable. Versus the other side, where if you're short and it keeps going against you, your risk is actually increasing as time goes on.
For sure. And looks like we had another question just drop in now. Looks like somebody's saying hi to Joel here. Looks like the question's from David Blumenthal, if that name rings a bell for you guys.
That's great.
Question coming in. What are you guys currently reading? Any books, magazines, publications, anything like that that's really catching your guys' interest right now?
I mean, constant. Bryan, you want to go first or me?
Apart from when we're reading kind of stupid science fiction,
We do a lot of that.
we do a lot of that. I think the book to mention that I'll plug Joel's favorite book of the last 2 years that opened up my mind was The Holy Grail of Macroeconomics by Koo. That was probably the most eye-opening book that I've read on what is a typically boring topic of economics. Has always been great. But yeah, I probably spend less of my time reading about business than I do about history and philosophy. So I have my perennial favorites on a regular basis.
Yeah, I tend to have a couple books going all the time. I'll plug Bryan's Super Forecasting. Phenomenal book. It was what we had done for years, but the way it's articulated, I would recommend everybody read it. And if it resonates with you, I think that's very valuable to know, because that tells you think in probabilities. If it doesn't resonate with you, that's also valuable to know, because you might want someone else to help you think in probabilities. And those are probably our two best recommendations right now.
For sure. Looking down our list now, another question came in. When talking about having a longer time frame than other investors, why do you use the word arbitrage?
Lack of any other better word. The markets are generally efficient over time, although I think you can begin to make the argument they're becoming sporadically less efficient with changes in market structure. If you go back 50 years, give or take, there were clear things to arbitrage, right? Like if I could go back in time and study with Joel Greenblatt and copy what he did, as I was kind of hoping to do after I read his work early on in my career, there were informational advantages to arbitrage. And if you go back further than that, Buffett was arbitraging informational advantages. And before that, Ben Graham sort of figured out, hey, why don't I just look at the balance sheet and I'll buy a net. As the industry evolved, there is so much information available that to have an informational advantage is hard, and I would argue dubious for fundamental investors. Because of the way the businesses have evolved and the industry has evolved, there is so much career risk and economic incentive to act a certain way that we often find investment opportunities, sometimes we call them skew trades, where if you're just willing to wait 3 years, the skew is so in your favor, it looks like an arbitrage. Why should it exist? And that's why we use the term.
Definitely.
That's what gets us excited, is we call them no-brainers. And if we can find them, we typically like to go big in them.
It's also what terrifies us. And people accuse us of being paranoid because we spend a few weeks asking, what are we missing? Why? But a lot of times we come back to this arbitrage concept where it's like, it's because people can't own them for 3 years. Can't wait.
For sure. And just out of curiosity, are there any big winners there on those kind of no-brainers that you guys have had pop up over the years?
Yeah, that's sort of the irony, is you buy these stocks where you're thinking it would take a lot to lose money. And because you're buying at a price where it's disliked, but over a longer period of time, it wouldn't take much for the expectations baked into the valuation that you paid to be exceeded. The irony of buying something like that is that if they exceed those expectations, the stock will go up a lot because you're going to get a re-rating and the boost off of higher operating profits. So a decent chunk of our track record is built off of stuff like that. I wouldn't want to pull any out, although I'm happy to go through examples if you guys want us to.
For sure. And we talk a lot in these presentations about valuing, buying companies. Usually most of it leans towards the buy side. Actually selling a holding, I guess, how frequently is that in the discussion, and how do you actually reach that point to actually go ahead and fully cut something out?
I think that's the hardest thing that we do. That the conversations around selling are usually both the most fierce and the most uncomfortable debates that we have as a group. I think that we've all seen that situation where you think you're a hero and you've made 40% and you sell it, and then you forget how great a business that was, and you go on and watch it go on a 10-year run, and you're like, how did I do that? We tend to drag our feet a little bit selling. We're very conscious to how we value the business. But when something approaches what we think is like a low IRR or roughly a fair value, it's probably when the research gets the most intense, and the debates get the most intense, and we just work it out. And we're not perfect at it. We're recording what we're doing, and we're trying to still find ways to do it better. But it's very hard, very, very hard.
Absolutely. And on the opposite side of the coin, do you have any holdings that you think pretty much you'll never let go of moving into the future?
I don't think we think in those terms, although I think we do hope that this conglomerate that we've put together, we think is balanced. And if it were an actual conglomerate, would stack up very well against most that you could put together in terms of the ability to compound over time and the price you're paying for it right here versus the price you'd be able to sell it at 5 years from now or 10 years from now. And so because the businesses are high quality, part of what we mean by that is the duration of growth should be long. And to the extent that they can keep compounding value, we would prefer to just hold. I think one of our known biases is we are probably overly conservative over time. We try to fight it, but it feels better to be a little bit conservative. It's why the buy side is so much easier. And it's also why the sell side's harder. So by knowing that our mistakes have been by being too confident in our ability to say the range, a lot of that has to do with our biases of not trying to lose money. And so if you own a really great business, they're not static entities. There's people running these businesses that are trying to figure out how to iterate and win. And the longer that you can let them do that for you, the better off you are.
Absolutely. And as we've rounded out most of our questions coming in the chat, I'll go ahead and put one out there more in a general sense. Current market, where do you guys see it heading near future, long term? What can we expect looking into the future, if you can predict it?
Our internal joke is we think the markets will fluctuate, most likely in the near term. We don't think we can forecast near term at all. We don't. It's why in our hedged strategy we set it up so we can be dealing from a position of strength for moves both up and down. And on the long only side, we try to ignore it as best we can. We do think that if we're talking about the market and using the S&P as a proxy for the market, the S&P is sitting at all-time high concentration levels. And so it's an interesting paradox where historically strategists or economists or top-down thinkers have had a lot of opinions on the market and bottom-up researchers haven't. And I would argue that should be flipping right now, because if you don't have an opinion on the top 30 names, why do you feel you're qualified at all to speak about this thing? Because you're talking about levels of concentration in an index that are more than many mutual funds. And so when you go through on a stock by stock basis, it's not great, but it's not bad either. You know, if you sit in a world where the 10-year is at 3% or less, you're probably making high single digits, mid single digits from here. And there's frankly a chance you're sitting at that level of interest rates, and the pent up demand from this pandemic period leads to better than expected growth. And hey, we were overly conservative again, and you got your 10% a year. Bryan, would you add anything to that?
No, I think I think because we're so bottoms up, and we're so focused on really what we know instead of there are large parts of the market that we don't know that could go up a lot more or could go down. We have no opinion about it. And when we look at our book, we see that there are generally still attractive names out there. We still really like our holdings. Can I say that we expect our forward returns to be the same as they were at the bottom of 09 or the bottom of 20? No, like clearly not. The price is way higher. But over a long term, I don't see anything that is truly scaring us.
Well, gentlemen, thank you so much for taking the time to come out today. It's been an absolute pleasure. Our audience is very much appreciative of all the great answers you've given and the wonderful presentation as well. Thank you so much for joining us. For those out in the audience, we will be posting the full recording here on our YouTube channel as well as on Guru Focus. So if you do want to go check that out, maybe look back at those slides, anything like that, you can do that as well. If you do want to tune in for future content, do please subscribe to our YouTube channel, like and comment on the video. That'll help us out with that YouTube algorithm and help more people get access to this content. So gentlemen, it's been an absolute pleasure. I wish you guys well, and I wish everybody in the audience well also.
Awesome. Thanks so much.
Adios.